going to hear about structuring yield products for institutions, DATs, and ETFs. From Tobias, BD lead at Staking Rewards, Elay, co-founder and CEO of Poly, Nick, co-founder and CTO of Turtle, Sthefano, head of LATAM at Figment, and Adrielle, director of sales for Brazil at Utila. Welcome, guys.
Yeah, success.
All right. Hello, everybody. So for this panel, we are trying to touch a little bit upon how to structure, basically, on the institutional side, yield products for digital asset treasuries and ETFs. And maybe before we go into the questions, it would be great for all of our participants to do a short introduction on what you're doing, where you're doing it, what's your role, and your background.
So hi everyone, I'm Elay, Elay Carmon. I'm the founder and CEO of Poly, and what we do is we do AI yield optimization for treasuries, foundations, and the way we do that is balancing yield and security, finding the optimal place for both of those to meet while we contribute to networks more security, and then we generate more yield with that. And that's what we call yield optimization.
Hi everyone, I'm Sthefano. I'm head of LATAM at Figment. Figment is one of the largest validators in the staking space. We have more than $18 billion of assets under staking. Have more than 1,000 institutional clients. We cover globally and started a new office in São Paulo back in March. So very happy to be here and talk to you guys. Most of our offerings, protocol staking, traditional protocol staking. We have 154 people just working on that. Our offering is on Solana, Ethereum, and most of the proof of stake networks.
Hey guys, I'm Nick, founder, CTO at Turtle. Easiest way to think of Turtle is like an investment bank for crypto, where we work with protocols to structure deal flow, price it, and then market that out to our network LPs on the back end to get them the best yields that they want.
Hi guys, I'm Adrielle. It's in Portuguese, but Adrielle for the American version. Utila is an institutional SaaS platform helping companies manage and operate with digital assets, all using secure enterprise MPC wallet infrastructure. We're a very relatively new company. It's been 2 years, but we're processing already over 20 billion in volume, growing more and more. I manage Brazil, but Brazil it's expanding a lot, and also, being here in Argentina, looking over all of the Latin America expansion as well.
All right, that's a very diverse group of panelists here, so I hope to also get a lot of diverse perspectives. For the start, let's zoom out maybe a little bit, and would be great to understand maybe if we are talking around the structuring side, to also understand what kind of problems institutions need to have solved when thinking about allocating into basically yield products around digital assets. Maybe Sthefano, you can start, and then the others can jump in and follow up.
Glad to. So what we've been talking most of the clients, not only in the region but globally, is that we are not only in the business of staking or competing with yield, we are in the business of the treasury management. So once you start to look on that perspective, you can understand what the forces are in each one of those groups. So we have ETFs, we have DATs, we have marketplace. Each one of them have a different force and sometimes different regulatory forces up to them. So when you have to understand how they treat their treasury under that regulatory light, and then you can understand which is the best product. Sometimes it's not even savings, sometimes it's a DeFi vault, sometimes it's different offerings. But most of what we do is to educate it, and educate to the point not only from the first guy that we spoke with, that education has to go through the hierarchy of any financial institution. So sometimes you have a really excited analyst talking to us, so the DeFi is amazing, staking is amazing, I'm really excited with the digital assets. And then 2 layers above, what is crypto? So part of our understanding is how do you speak the same language of all those peoples in those big institutional organizations? So, and then you can scale down which product is correct for each one of the clients.
What are the biggest pushbacks there? Is it like regulatory uncertainty or what?
Yeah, regulatory is everything. I would say that 80% of our success today, mainly in Latam and in the US, is due to regulatory updates. So of course, you have to have everything on set. You have to have good technology, good security, good compliance adherence, a really important team, founders that are focused on making the business grow. But at the same time, if you don't have a regulator close to you, and it's not going to work. And as an industry today, we're really, really lucky that the regulators are sometimes in the same stage or of knowledge or less than most of the people. So, and they are really, really interested in how this works. So we sit with the Central Bank of Brazil and explain to them what staking is, what are the details of each one of those staking offerings. And that was really super good experience because it's the first time you sit down in the regulator and you're going to think, oh, this regulator is going to be a sweet and tie and doesn't want to listen to me, but in the end of the day, they are super interested and super helpful in understand their side of the business of that.
Okay, so summarizing, like education, mainly around like regulatory uncertainty. Anything to add from the other participants to that?
I think that we found that it's both about, like was said here before, it's about mostly between risk and compliance. So traceability and replayability is very important. So you can see the trail and how everything has been played out, which is a big part of compliance, I feel. And that's something that we see that there's some sort of a balance, that a shift from just chasing yields and really kind of doing it more risk-oriented and something you can really track. And traceability here is a big thing that we also found from speaking to some participants and players.
Okay, and what are the products that are working best right now? The like yield products that have adoption? Is there any insights on that?
Yeah, I think at Turtle, it's probably too early for us to be interfacing with institutions directly to allocate to like yield products. It's not, we mostly interface with liquid funds. And so like in the US, for example, like a pension fund's not going to be farming DeFi on chain, but they may allocate to liquid funds that are, right? And so I think, we serve more of like that middle market where it's, okay, these guys are crypto native, they're already active on chain. We can obviously give them yield products and stuff to get them, exposed. So there's like indirect exposure, I guess, through those funds and into the bigger institutions. But just most institutions are not, even active on chain at all, right? So it's pretty hard to sell products,
Maybe that's a good transition to also go over into like the DAT and ETF topic, because that might be a way for also to tap into all the yield that is accessible on chain. Like maybe for the audience also, like if someone could briefly maybe explain the concepts behind like a DAT and ETF and the difference in between.
Yeah, I mean, I just look at it like if you put $1 in a box, like who can take the dollar back out? And for like ETFs, it's kind of like open market. Like if the box is trading below $1, somebody can buy the box and redeem for $1, and vice versa on the other side. Whereas like a DAT, it's up to the management team to manage the box, and that's the primary difference. And now we're seeing, the box initially was trading at a premium for a long time, and that's what Sailor did, and a lot of people tried to copy that trade, and now it's kind of flipped the other way because people are able to sell dollar boxes for $2 for a few years, and now it's kind of everybody's like 10-15% discount. And it's up to the management team to close that ARB now, and we'll see. Because there's, depending on the incentive alignment for the DAT, it's maybe not in the best interest for them to close the ARB. Like maybe they're already getting paid on AUM, and it's like, oh, let's keep the show running, even though the secondary price is below NAV. But yeah.
I think for ETFs, there's a bit of regulatory aspect. I think, Nick, you mentioned the regulatory part. Obviously, Sthefano being Brazil, you know that as well. There's also a liquidity part. Some ETFs don't want to, hold the 21-day ETH perspective. So I think that's the main difference between the two of them. Also, just, going from apart from the institutional bond, but on a peer basis, we've seen obviously ETF being way more adopted by the population itself. So if someone doesn't know what to do, they want to start, they feel way safer going to an ETF. That's exactly why it needs to have that regulatory perspective. Just, settle the difference here.
Okay, and then like I think DATs, they're also trying to differentiate, right? I mean, there are a lot of them popping up right now. So, and one angle is to do it through additional yield on top.
Yeah.
Do you see any preferences there? Like, what are the recent developments? Where do you see the space moving there?
Yeah, I would say that most of those clients and institutions, DATs or ETFs, they start with this traditional protocol staking in most of them. Because first is regulated, there's regulatory clarity on that, and Brazil, to give an example, just this week updated the regulatory framework and detail more of the staking capabilities that everyone should have. And yeah, the first step there is staking. You can understand as in TradeFi, staking serves, give or take, the same functions as the treasury bills in a portfolio. So reducing the volatility, reducing the risk. So after that, after you have a really secure staking operation, handling the liquidity and of course the yield and the adjusted to risk returns, then you go to more sophisticated products and looking always to how the supply chain of a treasury is going to understand that. Because when you're talking with a treasury, not talking only with the treasury team, you're talking with the administrator of those funds, you're talking with the lawyers, you're talking with their management team. So when you're looking directly to those clients, of course they react to different forces, but the structure is the same. You have to have a proper offering. Okay, I'm going to transform all my treasury to crypto. What are the checkboxes that you have to do? And the first one of the first is custody, then staking. Then we're going to explore lending. We're going to explore DeFi vaults, and it's like a pyramid, an inverse pyramid. And the volumes of each one of those layers, it's direct proportional how more liquidity, more regulatory oversight, more counterparties, and less risk.
I think the DATs just will start to look more and more like liquid token funds because it really stems from like a regulatory arb, because ETFs were obviously slow to get launched in the US, and for a long time people were getting exposure to BTC through MicroStrategy, and everyone was like short MSTR, long BTC going into ETF approval. And obviously it didn't play out initially, and so everybody started launching these things. But yeah, I think in order to like have an edge over an ETF, you kind of have to get some sort of yield on top of what you could get through an ETF. And now we're having staking ETFs, so they're probably going to have to go further out on the risk spectrum to differentiate. But yeah, at some point it just starts to look like a ETH exposed liquid fund or something, for these guys where they're just doing yield strategies with their treasury.
And who are the customers these DATs are competing for?
The customers that they're competing for?
Yeah.
Like the LPs? Yeah, I mean, it's just people that want like ETH exposure plus yield or something, whatever denomination of the DAT. Like it's, okay, instead of me buying an ETH ETF where I'm just getting exposure to ETH, I can get ETH plus yield. Though there's the inefficiencies with the DAT because they can't be, you can't arb the share price as easily, kind of relying on the management team to do that. It's not the best structure.
And I think we recently we talked about the benchmarks and like the transparency. Maybe how, like, maybe you can add about on that, Elay. How should this risk-adjusted yield be reported and benchmarked?
So first of all, I think it starts, when staking specifically, it starts with the selection of the validators. And I feel that for institutional players, there is a rule set of validator selection, and they can't work with just any validator. It has to be compliant validators. It has to be very clear on how these validators operate. From there, there's also the non-custodial part of it. They have to be in full control over their custody, basically, and have full control over their keys. And then, of course, there is the entire traceability path that basically shows how much rewards were generated on a certain day at a certain rate from which validators. And that is something I feel is very important. It's super granular for them to also understand. And you can see that they would prefer this, just like was said here, a lot of times the compliance and kind of that traceability perspective over even, I would say, yield, because it's so important for them, the compliant path to be done that way. So that's one of the things, for example, that we do. We trace validator activity on an hourly basis, and then we generate reports for our treasury clients. So it's very easy for them to see on a daily basis what's going on transaction by transaction and per validator or all validators. And I feel that that's super important as, again, for staking as the base yield layer for these institutional players.
Okay, and then maybe for Sthefano, right? You're competing also with other validators, I guess, around these LPs, and you need to make a point on, like, you are compliant, right? You are managing the infrastructure in a reliable way. How do you even prove that to the LPs, right? To the depositors, to the customers? How does the process work?
Yeah. Answer to your question is be really close to the clients and work with them. So non-custodial is undeniable one of the best offers. Have to, as say, non-custodian, OFAC compliant, have the infrastructure that is traceable and auditable from the authorities and this kind of stuff. But mainly understanding what's the drive to the client. So what do you want? I want to sit, we're a new industry. We have a bunch of smart people in this room, in other rooms, that are every day researching and creating new solutions. But those solutions, they are good as they are usable. So what's more usable to? So sit down with the client and work together with them, like every week, what you need, what your regulator and what's your management or what your clients are asking you to do. So you need more validator. You need client diversity. You need faster, better timing games. Doesn't matter. There's a bunch of variations that you can do on staking and other yield products, but they have to come from your client.
Okay. And what are like the absolute non-negotiable components when you are talking to these institutional investors?
I think pretty much everything that was mentioned here already, the transparency, they want to be in full control. You can't just go to an institution and say like, hey, we're going to offer you a yield of 4%, whatever, just give your money to us. We all know it doesn't work like that. We've seen it happen and it didn't work. So I think, being very transparent on what are the costs, if there are any intermediary costs. So if you get to a yield of, 3%, that's the math. Everyone is going to take this part or whatever. They feel way more secure when you're being completely honest to them. I think obviously the whole part of the technology, so maybe, SOC 2 compliant, we've seen it get asked more and more. segregation of wallets on the legislation that Brazil launched. Like, I think the first point was you can't mix the funds. So there has to be a wallet segregation for each of your customers, for your own funds, for DeFi. I think those are the main that comes to mind. If anybody wants to add anything else.
From our perspective, it's also the clients, they have to be able to control the rules for validator selection on an ongoing basis. Non-custodial, no question. Also, the ability to, again, audit everything, and of course, slashing and jailing protection on an ongoing basis.
Okay, and on the fund manager side, how is it there? From the selection criteria, right? You are acting kind of as an intermediary at Turtle, I guess. What are their questions when it comes to the DeFi opportunities from a risk perspective?
Yeah, it's very similar. Probably less strict as like a large institution, but yeah, I mean, every deal that we list, we KYC, audit, do additional off-chain risk assessments around signing keys, securities, posture towards different events for that yield product, and then of course like the actual risk of the product itself. Like, are you doing off-chain lending? What's the collateral? Who's involved? And so yeah, it's no different for liquid funds. They're probably just a little more a little easier to get across the line for actually deploying into these products.
But is it staking they're looking for? Or?
I would say it's generally like we work mostly with protocols that are early on in issuing incentives. Like, you can imagine, like Athena back in the day when they did their early incentives program for early LPs. You basically get this equity-like upside in the tokens for providing liquidity up front to kind of seed this tokenized basis trade or seed this money market or something. So that's primarily like the deals that are attractive and like a risk-adjusted yield, because you're really just getting like equity upside plus like taking early risk in some protocol that's new.
Okay, so but that is something that will be hard to be replicated at the DAT side, no?
I mean, I could see DATs maybe deploying into that at some point, but I think it is probably too early. I think the DATs, it's mostly just getting staking across right now, and then once staking's in ETFs, then they probably have to move further out the risk spectrum into lending and stuff to keep up. But yeah, us interfacing with DATs today would mostly be like a staking conversation.
Okay, and where maybe also for the others, where do you guys see the whole space move within the next year or 2 years? I mean, it has been switching a little bit from what it used to be. So it would also be great to get your perspectives. How this DAT space will develop. Is it sustainable?
I think we've seen that there's a race. Who is offering more? Who is being more secure, compliant, or whatever. But also, Sthefano said something that it's really important. It's the actual use case. Is there a use case that you're solving? In Brazil, for example, we are seeing a boom of tokenization, RWA. There is an actual case there to be solved. Brazil is a very bureaucratic country, for example. So if we're talking about, like tokens in the real estate space or automobile space, whatever, I think it's growing. I think they're working closer to the regulators and companies to offer you products on that as well. We have seen a growth. I think the other countries in Latin America are going to keep up with it. So I would say that side, for me, is the one that it's going to, in the next future is going to come up on the institutional part, I mean.
Yeah, I think like the DATs is what they call like reverse tokenization or something, where taking tokens and putting it in a wrapper that TradFi can interact with. And I think there'll probably just be more and more of that with yield products too over time, where it's okay, these guys can plug into this TradFi wrapper, whether it's an ETF or something else, and we'll put tokens in there, and then those people can get exposure that way, and then we'll have more tokenization of equities and stuff on the other side for crypto people to interact. So it's just kind of like the merging of these two worlds. through interfaces, really, and standardization, I think will continue.
I think, in my view, it's a wild west right now, right? So people are doing whatever they think it's good for their companies, and it's calling a lot of attention. So as every cycle, it becomes like a wild west, and then people get hurt, and then regulators start to look into it. Oh, you have to have rules on that in place. So I think in the next 5 years, we should see more of those rules that are maybe sometimes applicable to, not the same rules, but the same set of scrutiny that you see into the ETFs going into the debts, and those companies has to be more compliant, not only to the rules in their respective markets, their capital markets rules, but also I think is going to have new rules for those kind of companies, because they're not going anywhere. Even if everything blows up with MicroStrategy and those kind of stuff, you still go, the cat's out of the box now. So always somebody's going to, oh, it's a really good idea to transform this treasury, get out of this fiat, move to crypto because store of value, or I want my company to be more involved on settlement layers and whatever I want. This is not going away. So in 5 years, we're going to have more DATs, in my view, but we are also going to have much more regulation into it.
I want to say that from my perspective, I feel that we're going to be moving from simple staking to more optimized staking, which is going to be more performance-based. Again, from custodial to non-custodial, more control and more ability to actually see the activity of the yield being generated. And then from there, it's really going to develop from, the kind of like the traditional yield from TradFi into on-chain, which is much more predictable, much more clear, much more transparent. And that's going to also, I feel, shift in the paradigm of yield in general, because that's what blockchain enables, yield generated by blockchains enables, basically.
Okay, maybe also like one last question from my side, to touch upon the AI point that you mentioned earlier.
Yeah.
When it comes to like partnering or structuring a product around staking with multiple validators, right? Mm-hmm. What role do you think, and also from a performance perspective, what role do you think AI can play there, and also what opportunity is there?
So I feel AI has an interesting role here in creating a balance. So it's not just going for, is it only yield or is it only decentralization or security, but it's kind of both. It's kind of, I say even all three. It's yield, decentralization, and security, and finding that balance where validators, which, like again, institutionals have a certain set of players that they can be working with. They would have to be, AI basically would measure performance of validators in real time and would redelegate to the top performing validators in real time, not only from a perspective of yield, but also from a perspective of preserving the security of a chain and of a network, which essentially raises the value of its token, and then also contributes to the decentralization of that chain, which basically makes it more efficient. So it's that balance that I see that AI is really going to be playing when it comes to yield. Now, staking is the first use case, but I think that in general, distribution and the right proper distribution management and yield in general moving forward will be where we see AI really fitting into the whole world of blockchain and yield.
Are you, to the others, are you discussing integrating anything into your products on the AI side as well? I mean, with Figment, for example, could imagine.
I think not specifically that I can say, but yes, there are some initiatives, because it's a marriage that you can't avoid, right? So AI needs a bunch of data to be trained correctly, and the LLM models and crypto staking, they generate a bunch of data. So I think the challenge there is how do you match those things correctly to be, again, not repetitive but useful. What data that you can use from your validators to be pumped into a LLM model, and what you're going to do with it. So that's, I think, is the challenge to think about right now.
Yeah, we use AI across the board. I mean, not only on like the development side, but also I think we're seeing a lot of these vault strategies now that have AI-based curation. I'll be interested to see, you know, how those perform over time, and like you kind of do need to sandbox those to some extent because you don't want this agent to just be deploying into risky stuff. But yeah, it's interesting stuff happening on the curation side. But yeah, Turtle ultimately has like just a ton of user data on the back end, and so us like curating deals for individual users via AI is definitely on our roadmap and coming soon.
On our side, I would say that there are companies who manage the AI part for us, so we partner with them to make sure that everything is handled in a simple way to our customers. Our customers are all institutions. They don't want to have to learn new things, understand new things. They want all-in-one platform, and that's what we try to do. So we have a lot of partnerships, not only with AI, but other products as well to attend our customers.
All right. I think we are already a little bit over time here. But yeah, it was a great discussion. Thank you, everybody, for joining in. And yeah, talk soon.
Thank you.
Thank you.
Okay.